Well, thank you very much for joining me in this video. You know, we work on the premise that real estate prices always go up. And over time, that's always true. I teach investment seminar. I believe in investing in real estate, and it works on that premises that properties are going up in value over time. Now, there are exceptions. For example, if you happen to be talking about a little community in northern Ontario that's a mining town and the mine closes, properties are not going to go up. There's no demand, people are going to move away. We saw that happen in Newfoundland when the fisheries took a real hit and all of a sudden properties lost all their value. And we have that happen from time to time. But there's another reason why prices may not continue to go up over a particular period of time, and that's after a real strong run-up when you get an equivalent recession. It's kind of like waves of the sea, goes up and goes down, goes up and goes down. We know overall, over time, it will continue to go up. And it'll go up because cost of living is always increasing, inflation is always increasing, and price of property should always go higher than the cost of living because you've got increase in population, therefore an increase in demand, and you don't have an increase in supply. We're not building more land. And so overall, it will continue to go up. But as I said, there's times when it will not, and those times usually follow a real strong increase in price. I had a friend who operated in Sarasota, Florida, and told me that in 2007, prices went up 80% in 1 year. Well, then they hit 2008 and the bottom just dropped out of the market in the US for a period of time. And we kind of saw the same thing during COVID. During COVID, we saw an unprecedented run up in prices from say 2020 to 2022, we saw a real increase in price. And then we saw the downturn, and from 2022 on, prices have been eroded and sliding back down. That creates some unique challenges for homeowners and for realtors. One reality is that 5 years ago, we saw the peak almost in prices. Prices were very, very high. There was frenzied buying, multiple offers, and so on. Well, those properties, the people who bought then, their mortgages are up for renewal. And so we're seeing mortgages being renewed starting last year and very heavily into this year. Perhaps when they bought the property, they may have been looking between 1 and 2% interest rate on their mortgage. Now it's more than double that. And talk about sticker shock. All of a sudden they've got a huge hit in how much they're paying every month. And where I'm told that because of that, they're seeing an unprecedented number of people getting into arrears in their mortgages and defaulting on their mortgages. One of the things, the challenges, is for homeowners themselves, when their mortgage is coming up for renewal, in a normal market, it gives them an opportunity to shop. They can go from one lender to another lender, and they can see who will offer them a better deal if they switch from one lender to another. They don't have that luxury now, because if they were to have their property appraised, it wouldn't appraise what they paid for it, and it probably wouldn't qualify for the mortgage they have on it. And so they, as long as they've been current and making their payments, the bank they're with will just automatically renew their mortgage, and that's the only course that they have. So they got some challenges, but they've also got some challenges keeping those payments up with the increased level of interest on the mortgage. And it creates some challenges if and when they want to sell. We use the term underwater, and a lot of sellers, their houses are really underwater, not physically, but financially. What I mean by that is the property isn't worth as much as the mortgage that's on it. Or maybe there's very, very little equity on top. They've got the down payment when they bought it, and they've got the amount of principal they've paid down over 5 years of paying a mortgage, but with the eroding of prices, sometimes up to 25-30%, they probably have almost no equity at all in that house if they want to sell. And so it creates a challenge to the realtor. Realtor wants to list the property for sale, but you want to make sure that there's enough money to complete the sale, and you want to make sure there's enough money to pay a commission out. And so you need to do your homework. And you need to be very careful in what you're checking. I remember years ago, I had a property listed for sale. It was going to be tight. And we came time to close, and it was back when they physically went to the registry office, And the lawyer was telling me he was going to the registry office 2 and 3 times a day because people were getting wind that this property had sold and they were slapping liens on the property, one after another after another. It was going to be a challenge to close it. We finally got it closed, but it wasn't simple. And so if you are a realtor and you're asked to list the property and you know they bought it in that height in the COVID period, you want to do your homework. You want to find out how much they owe against it, and you want to find out what the market value, of course, is, and do some challenging and some checking before you decide whether you can list it. You may decide you're not going to list it at all because there's just no equity there to close the deal, or there may not be any equity to pay out the mortgage. And don't forget, if you are listing a property for sale, it isn't just your commission that's at stake. You're going to be listing at MLS. It's going to be open to the market, and there's going to be other agents perhaps involved bringing in an offer, and you don't want to be the one to tell them the bad news. I'm sorry, there's no money for commission. So you want to do your homework. The other thing is that don't be afraid to involve the banks. Follow what I'm saying here. And bear in mind that if the seller is under contract with you, they're your client, you can't go talk to their bank without their consent. But they recognize they're in a problem. They recognize that there's some really serious situations here, and they would probably welcome you talking to the bank to see if you can structure some kind of a deal. What kind of a deal can you structure? Well, you say to the bank, look, you're going to be going power of sale. This person is already delinquent in their mortgage, and I can get as much as possible as far as the market value today for the sale of this property. And if we delay it until the whole power of sale is in place, you've got extra legal fees, you've got extra carrying costs, and so on. So I'm just wondering if I can work with you now, and if I can get you to sign on with the listing and work with me and take a look at any offer that comes in and see if there's some way we can make it fly. And the chances are really good that the bank will do that because they recognize they got a problem and they can recognize that this can actually help. And you'd be surprised at how much wiggle room you can have with lenders. I bought a property personally about, I'm going to guess, 10 years ago. It turned out there was an awful lot of money owing against the property. I was paying full market value for it, but the owner had been involved in a business with a partnership. It's a whole other story. But that partnership, as a result of that, there was hundreds of thousands of dollars against the property. Nothing to do with the property itself, but it created liens that couldn't possibly be covered with the sale. The lawyer got working, and he was working with all the creditors, and he got them all to lift the execution to let the sale go through, and they did it on like 10 cents on the dollar. He even got Revenue Canada to lift their execution and put it back in place again. They were going to get something, and they knew they weren't going to get any more if they didn't work with this offer, and so they did. And of course, the person still owed the money, but it wasn't secured against the property any longer. And so working with the banks, working with the lenders, you can often work something out to make it happen. But do your homework and go through those steps. Don't just hope it's all going to come out. And then I had an agent call me the other day, and they were saying it's going to be very tight. Don't know there's enough money for commission. Is there any way I can get some kind of a promissory note or something to guarantee the commission? Well, you can. You don't need to because the seller is under obligation to pay the commission. You can't put a lien on the property because he isn't owing you the commission until closing. And so you can't anticipate non-payment and lien the property, but he does owe you the money. And often the lawyer who's going to close the deal will call and say, I'm sorry, there's not enough money for a commission. And you can say, would you mind drafting up a promissory note from the seller and also a repayment schedule, how he's going to pay it back, so much a month or so much, well, however you're going to work it out. Now, you may not be in a position to get anything because the person may not have a job, but if they're working and they just run into a real problem because of an increase in mortgage payments, there's a good chance you will get paid over time. But you need to plan, you need to do your homework, you need to make sure you understand the situation, and you need to take proactive steps. Hope that makes sense. We're going to see some more of it in the next, I would say, year and a half. And to be forewarned is to be forearmed. Thank you very much for joining me in this video. Talk to you again next week.